Have a
Sure,
great
no
day.
problem.
Larry Levin of secretsoftraders.com. Also want to talk about oil because those prices trading near 1-month lows. So what are traders to do if they'd been anticipating big gains in these winter months? And what are some of the best ideas for commodities in 2007, particularly if you're changing your strategy on oil? So for this week's Commodity Corner, our commodities reporter Sandra Smith and I are joined by Kevin Kerr. Kevin is editor of Resource Trader Alert. It's a newsletter for commodities trading. He is joining us today from Stanford. And Kevin, you've been a staple for us as we've had this Commodities Corner and really launched it here over the past few months. We have to, because it's a year-end here, revisit some of the picks that you've had. And you've been really bullish on oil. It's not panned out. Why not? And what did you get wrong?
You know, I'll tell you what, it has and it hasn't. I mean, obviously this last part of the year, we've seen oil pull back. There's been a lot of factors here. Right now, really what's weighing on the market is weather. I mean, it's amazing that the last couple of days, the activity we've seen with the pipeline bombing in Nigeria and then the problems that are going on in Iran and the threats of using oil as a weapon, all of these things are very bullish for the market and have had very little impact. Obviously, yesterday and then the day before's action have been very skittish at best, and a lot of that is just based on weather and the predicted warm weather going in the next couple of weeks.
All right, you're saying it's based on weather. I hear that. But the ability of traders then over the past few weeks to kind of shake off some of these big themes and really big concerns out there, does it show perhaps a fundamental shift, or does it show perhaps that some of those factors are priced in given that we're at $60 and we've had such a tremendous run over the past few years?
Yeah, we see a real base here at around the $60, $58 a barrel level, even with the weather factors already in the market, a lot of the fear already taken out of the market these last few months. And so we feel this is really the base for prices here. You know, we've got a lot of factors that are going to hold the price at this level, with China buying for their 5 reserves that they have. Every time we get down to this $58 or $60 barrel level, we seem to find a lot of support from traders and from the markets. And we don't see it dipping much further below this level, regardless of weather or any of the other factors.
All right, so how high do you see prices going, and does that become a long-term play rather than an in-and-out strategy for folks who you think should be trading and are trading here?
Well, the markets, the energy markets, especially natural gas, are difficult. You don't want to turn your back on them. It's like the ocean. You know, if we do get a cold snap in January, you could see prices run up very quickly, back up to the $64, $65 a barrel level, certainly back up to the $6 or $7 level for the natural gas. And that's very quickly if we get cold weather. We don't need significant drawdowns to drive prices back up to those areas.
Kevin, it's Sandra here. You've also been forecasting $700 an ounce gold on the dollar weakness, which we've seen. What's gone wrong here, and are you going to hang on to this forecast?
Yeah, we are. We're going to extend it out a little bit into next year. Obviously, this has been tied in with the dollar, and the dollar did find some strength here at the end of the year, which helped pull prices back. We didn't quite reach the $700 level this year. We're going to have some resistance back up to where we got to this year at around $660, $670, and then we see it pushing through up to $700 next year, probably by mid-year.
I know one of the biggest things that you were counting on were those investors that pulled out after the 24-year highs in May. They all kind of shook out of the market. You were planning on those investors come back. Have you seen them back in this market?
Yeah, and I think we're already seeing them pile back in at the end of the year here. We've seen the gold and silver ETFs get a lot of activities the last few days of the year, and we think a lot of these buyers see value down here at these levels and figure that the price is going to climb. How far, nobody's certain of, but will climb into next year and see it as a good value down here.
Well, and that brings me to my next point. You said that you know, some of the bigger moves in 2007 could be some things that are under the radar right now, perhaps some new ETFs, like you just mentioned, on gold. What are you forecasting there? Do you anticipate a new ETF to come out?
We do. We predict that there will be several new ETFs this year. In which specific markets, we're not certain. It could be things that we aren't even talking about yet, or it could be offshoots of some things that we already have in the metals or other markets. But we've seen these ETFs be very successful, and we don't see them slowing down at all. Some of the more markets that are flying under the radar, like last year when I talked to you about corn, this year we see it being markets like soybeans and the grains and other markets that might have been a little far behind last year.
Kevin, it's Ellen here. Sandra and I last week had a guest on in Commodities Corner, and we were talking about soybeans. So it's interesting to kind of hear this this echo here. Part of the concern seems to be that folks are going to plant perhaps more corn will take away from soybeans. Is that the play you're anticipating, or is it something else going on?
No, that's a big part of it, Ellen. We feel that farmers are going to be planting more acreage dedicated to corn because there's an obvious immediate benefit, and that soybeans will take a little bit of back seat, and that soybean prices could as much as double next year based on that lack of supply. We do see farmers already heading that way for next year.
Beans in the teens you're forecasting this coming year?
Well, let's go as high as 13.
Okay.
I don't know about 16, but 13.
Wow. Would you hedge that bet? I mean, that's a pretty bullish bet.
I wouldn't be that aggressive, but I'd be looking at options that will let me take advantage of prices that are higher than here, maybe 3 or 4 higher than here.
And in terms of soy, what would your biggest concern be? What would you make you less bullish there?
Well, if demand starts to decelerate here and we don't have as many farmers switching to corn as we expect, that could put an impact on the market and make it hold right about at these levels.
All right, Kevin, we want to thank you for helping us have so much fun with Commodities Corner in 2006 and look forward to having you back on in 2007.
Thank you so much. Have a great new year.
You as well. Kevin Kerr joining us there from Stanford. All right, meantime, Apple, it is hitting the skids today. The stock is down again. It's breaking key support levels along the way. We have a special exclusive Bloomberg look on the story and more coming up.